Introduction: The difference between gambling and engineering. Imagine two investors. Let's call them Alex and Jordan. Alex just made $1 million. He put his life savings into a single volatile tech stock he read about on a Reddit forum, and within 6 months, it skyrocketed. He feels like a genius. He's buying a new car, telling his friends they need to get in the game, and he's already looking for the next moonshot. Then there's Jordan. Jordan also has $1 million, but it took her 10 years to get there. She didn't find a hot stock. She built a portfolio of boring, diversified assets. She automated her savings. She scrutinized her expenses and optimized her taxes. She didn't celebrate when the market went up, and she didn't panic when the market went down. On paper, right now, they are worth the exact same amount. But here is the brutal truth. Only one of them is likely to be broke again in 5 years. And today, we are going to ensure you become the other one. The difference between Alex and Jordan isn't their net worth. The difference is how they got there. Alex is a financial gambler who has confused a lucky outcome with a smart decision. Jordan is a financial engineer who has built a system that generates wealth regardless of luck. Welcome to Beyond Luck: Critical Thinking for Financial Security and Growth. If you picked up this audiobook, it's likely because you suspect that the get-rich-quick narratives flooding your social media feeds are missing something fundamental. You might feel a low-level anxiety about your money, not necessarily because you don't have any, but because you aren't 100% sure you're doing the right thing with it. You might worry that you're missing out on the next big thing. Or conversely, you might be terrified that a market crash is going to wipe out everything you've worked for. That anxiety exists for a reason. It exists because most of us are taught how to earn money, and some of us are taught how to save money, but almost none of us are taught how to think about money. We look at charts, we read news headlines, and we listen to pundits screaming about buying or selling. But we rarely stop to examine the operating system that processes all that data: our own brains. Here is the central premise of the next 2 hours we will spend together. In the world of finance, your biggest enemy isn't inflation, it isn't the Federal Reserve, and it isn't a stock market crash. Your biggest enemy is your own biology. Human beings evolved to survive on the savannah, not to trade derivatives on the stock market. We are hardwired to run from danger, which makes us sell at the bottom when we should be buying. We are hardwired to seek social validation, which makes us buy into bubbles at the top because everyone else is doing it. We are designed to prioritize immediate gratification over long-term security. When you rely on your gut instinct for financial decisions, you are relying on a survival mechanism that is millions of years old and completely unsuited for modern economics. This is why lottery winners almost always go bankrupt. This is why professional athletes who make millions often retire poor. They have the capital, but they lack the critical thinking framework to keep it. The trap of resulting. One of the most dangerous things that can happen to a new investor is making money on a bad decision. Think about that for a second. If you drive home drunk and you arrive safely, was it a good decision to drive drunk? Of course not. You were just lucky. But your brain learns the wrong lesson. It says, "I did this and I survived, therefore I am good at this." In poker, this is called resulting, judging the quality of a decision solely by its outcome. In finance, this is deadly. If you make a risky, unresearched bet and you win, your brain releases dopamine. You feel validated. You feel skilled. And because you believe you have skill, you double down. Eventually, the law of averages catches up. The luck runs out, and because you never built a safety net, you crash. This audiobook is about breaking that cycle. We are going to move you from resulting to process. We are going to shift your reliance from luck to logic. What you will learn. Over the course of 16 chapters, we are going to dismantle the illusions that keep people poor and build a fortress of mental models that make people wealthy. We aren't going to tell you which stocks to buy. Giving a man a fish feeds him for a day. Telling him to buy a specific ticker symbol just makes him dependent on a guru. Instead, we're going to teach you how to analyze any investment, any opportunity, and any risk with the cold, clear precision of a master chess player. We're going to explore the biology of bad decisions and how to hack your own psychology to avoid panic selling. We'll look at the sunk cost fallacy and why it's so hard to cut your losses. We'll discuss why you need to stop thinking in binary terms of right or wrong and start thinking in probabilities. We will teach you about asymmetric risk, finding those rare opportunities where the upside is life-changing, but the downside is merely an annoyance. We'll dive into second-order thinking, where you learn to ask, and then what happens, seeing the consequences that others miss. We'll talk about signal versus noise, helping you filter out the media hysteria that is designed to make you click, not to make you rich. We will explain the true logic of compounding, which is the most powerful force in the universe, yet the hardest for the human mind to comprehend intuitively. And we won't just talk theory, we're going to cover the practical architecture of wealth. We'll talk about the margin of safety, opportunity cost, and contrarian thinking. We will show you how to build a system that is antifragile, a financial life that doesn't just survive chaos, but actually benefits from it. The shift from hope to strategy. By the end of this book, you will have a specific set of tools, a checklist for your mind. You will no longer cross your fingers when you make an investment. You won't lie awake at night wondering if the market will crash, because you will have a plan for if it does. You will understand that hope is not a strategy, luck is not a business model, and gut feeling is usually just indigestion masquerading as intuition. Real financial security comes from knowing that even if you are unlucky, even if the economy tanks, even if you lose your job, even if the unexpected happens, you will be okay because you didn't bet the farm on a single outcome. You engineered a life that can withstand the storm. This journey requires honesty. You have to be willing to look at your past financial mistakes and admit that maybe, just maybe, you weren't unlucky. You were just unprepared. You have to be willing to let go of the ego that wants to be the smartest person at the dinner party who picked the winning stock. You have to be willing to be boring, methodical, and disciplined. But here is the reward: freedom. Not just the freedom to buy things, but the freedom from fear. The freedom of knowing that your financial future is not in the hands of a fickle market or a random roll of the dice, but in your own hands, guided by a sharp, critical mind. So are you ready to stop gambling and start engineering? Are you ready to stop being the investor who gets wiped out by a shift in the wind and start being the one who builds a windmill? Forget the lottery mentality. Forget the idea that someone else holds the secret key to your wealth. The key is critical thinking, and we are going to forge it together. Let's begin by stripping away the illusion of control in Chapter 1. Chapter 1: The Illusion of Skill. There is a dangerous trap that waits for every new investor, entrepreneur, or decision-maker. It's not a scam, and it's not a market crash. It is a simple psychological mechanism that convinces you that you are a genius when you are actually just lucky. Imagine you walk into a casino and put your entire paycheck on red 7 at the roulette table. The wheel spins, the ball bounces, and incredibly, it lands on red 7. You walk out with 35 times your money. You feel ecstatic. You feel powerful. But most dangerously, you feel like you knew it was going to happen. You start telling yourself, "I had a feeling," or "I noticed a pattern in the wheel." But did you make a good financial decision? Absolutely not. You made a terrible decision with a fantastic outcome. In the financial world, this distinction between the quality of your decision and the quality of your result is the difference between long-term wealth and eventual bankruptcy. We often assume that if someone got rich, they must be smart, and if someone went broke, they must be foolish. But markets are noisy, chaotic systems where luck plays a massive role. In this chapter, we're going to separate the signal from the noise. We're going to expose the illusion of skill so you can stop fooling yourself and start building real competence. Defining resulting. Psychologists and professional poker players call this phenomenon resulting. It is the tendency to equate the quality of a decision with the quality of its outcome. If you buy a speculative cryptocurrency because your cousin told you it was going to the moon and it triples in value, resulting tells you that you are a savvy investor. It tells you that listening to your cousin is a valid investment strategy. The dopamine hit from the win cements this neural pathway in your brain. You have been rewarded for a bad process. This is dangerous because the market is a bad teacher. In a classroom, if you study hard, you usually get a good grade. If you don't study, you fail. The feedback is consistent. In the market, you can do zero research, buy a terrible company, and make money because of a meme or a rumor. Conversely, you can spend weeks analyzing a balance sheet, make a prudent investment, and lose money because of an unforeseen global event. If you judge your strategy solely by the immediate profit or loss, you will learn the wrong lessons. You will repeat the risky behaviors that got you lucky, and you will abandon the prudent behaviors that got you unlucky. You need to divorce your ego from the outcome. When you make a trade or an investment, ask yourself, if I played this exact scenario out 100 times, how many times would I win? If the answer is only a few times and you won anyway, admit that you got lucky. Take the money, say thank you, and never do it again. Do not mistake a winning lottery ticket for a business plan. Now, you might be thinking, but look at all those billionaires and famous investors. They took big risks and it paid off. Why shouldn't I? This brings us to the second illusion, survivor bias. When you look at the financial landscape, you are looking at a graveyard that has been paved over. You only see the buildings that are still standing. You see the one tech founder who dropped out of college and built a unicorn. You don't see the 10,000 dropouts who are currently struggling to pay rent. Financial media loves a winner. They put the person who predicted the market crash on television, but they never mention that this same person has been predicting a crash every single year for the last decade and has been wrong 9 times. When you consume investment advice, you are consuming a filtered data set. You are hearing from the people who flipped the coin and got heads 10 times in a row. They will write books about their heads-flipping strategy. They will sell courses on how to flip heads. But if you follow their advice, you are just as likely to get tails. To combat survivor bias, you have to look for the invisible data. When you study a successful strategy, ask yourself, who else tried this and failed? If a strategy requires perfect timing, massive leverage, or inside connections to work, it is not a strategy. It is a gamble. True financial skill is repeatable. It works in up markets and down markets. It doesn't rely on being the one survivor out of 1,000. It relies on being the one who built a sturdy enough boat to survive the storm that sank everyone else. So if we can't trust our outcomes, and we can't fully trust the winners we see on TV, how do we know if we are actually getting better? You need to build a decision audit system. Most people track their net worth. They look at the number at the bottom of the spreadsheet. If it goes up, they're happy. If it goes down, they're sad. I want you to start tracking something else, your decision-making process. Here's a practical exercise you can start today. Before you make any significant financial move, buying a stock, selling a house, shifting your 401k, open a document or a notebook. Write down these 3 things. First, write down what you are doing. I am buying 100 shares of Company X. Second, and this is crucial, write down why you are doing it. Be honest. Is it because you analyzed their earnings report? Is it because you like their product? Or is it because you saw a headline that scared you? Or because you're afraid of missing out? Third, write down what you expect to happen and in what time frame. I expect this to grow 10% over the next year because they are launching a new product. Then close the notebook and make the trade. 6 months or a year later, open that notebook. This is where the magic happens. You compare the result to your reasoning. If the stock went up but for a completely different reason than you wrote down, maybe they got acquired by a larger company. You cannot take credit for that. You were wrong about the why, but lucky about the result. If the stock went down, but your reasoning was sound, maybe the whole market crashed, you can forgive yourself. Your process was good, the environment was bad. This decision journal prevents you from rewriting history. It forces you to confront your actual logic, not the logic you invented after the fact to make yourself feel smart. It is the only way to verify if you are developing true skill or just riding a wave of luck. But even with a perfect process, there is a biological limit to how rational you can be. You are fighting millions of years of evolution that screams at you to run when you see red and get greedy when you see green. Now that we know luck exists, let's look at the biggest obstacle to your wealth, your own brain. Chapter 2: The Biology of Bad Decisions. Have you ever made a financial decision and then 10 minutes later wondered, what on earth was I thinking? Maybe you panic sold a stock the moment it dipped, locking in a loss only to watch it rebound an hour later? Or maybe you bought something expensive you didn't need just because you were having a bad day and wanted a pick-me-up. When that happens, you usually blame your intelligence. You tell yourself you were being stupid. But I'm here to tell you that you weren't being stupid, you were being human. The hardware inside your skull hasn't had a significant upgrade in about 50,000 years. Your brain was designed for a world of immediate physical danger and scarcity. It was built to spot a lion in the grass, to find food before you starved, and to fit in with your tribe so you wouldn't be cast out to die alone. It was not built to analyze price-to-earnings ratios or to understand compound interest over 40 years. This mismatch between our ancient biology and our modern economy is the root cause of almost every financial mistake you will ever make. To win the money game, you don't just need to understand math. You need to understand your own biology. The flight or fight response to market volatility. Let's talk about what happens physically when you see your investment portfolio drop by 20% in a single day. Your eyes see the red numbers. That visual data travels to your brain, and before your logical center, the prefrontal cortex, can even process what it means, a tiny almond-shaped structure called the amygdala hits the panic button. This is your fear center. To the amygdala, losing money looks exactly the same as being chased by a predator. It perceives a threat to your survival. Instantly, your body floods with cortisol and adrenaline. Your heart rate spikes. Your pupils dilate. Your blood rushes away from your internal organs and toward your muscles so you can run or fight. But here is the critical part. During a flight or fight response, your brain deliberately shuts down long-term planning and complex reasoning. Logic is slow, survival is fast. If a tiger is charging you, you don't want to contemplate the philosophical implications of death. You want to run. So when the market crashes and you feel that tightening in your chest, you are literally chemically incapable of thinking rationally. Your brain is screaming, "The threat is right here! Make the pain stop! Get out now!" That is why people sell at the bottom. They aren't making a financial calculation. They are relieving an anxiety attack. They sell to stop the pain of uncertainty. And the moment they click sell, the cortisol drops and they feel better physically until they look at their bank account a week later and realize they just destroyed their future wealth. Understanding this mechanism is the first step to defeating it. You have to recognize that market volatility triggers a physical threat response that is a false alarm. The trap of immediate gratification. If the amygdala is your enemy in a crash, your dopamine system is your enemy during the calm. Humans are hardwired for what economists call hyperbolic discounting. In plain English, we value a reward today vastly more than a bigger reward tomorrow. Again, this makes sense evolutionarily. If you were a hunter-gatherer and you found a berry bush, it made sense to eat as much as you could right now. If you saved the berries for next week, they might rot, or a bear might eat them, or you might be dead. The future was uncertain, the present was real. But in finance, the opposite is true. The present is expensive, and the future is where the wealth lives. This is why saving money feels like a punishment. Your primitive brain sees money in your checking account and thinks, resources, consume them now. When you move that money into a retirement account that you can't touch for 30 years, your primitive brain registers that as a loss. It feels like you are throwing the berries away. This is why retail therapy is a real thing. Spending money releases dopamine. It gives you a quick hit of pleasure. Investing money is boring. It offers no immediate chemical reward. To overcome this, you have to trick your biology. You have to make the future feel real. One technique is to vividly visualize your future self, not as an abstract concept, but as a real person who is depending on you. When you choose not to invest, you aren't just saving money, you are stealing from that future person. Recognizing emotional triggers. So, how do we protect our wallets from our own instincts? You need to install a circuit breaker. Never, ever make a financial decision when you are in a heightened emotional state. This applies to negative emotions like fear and anger, but also to positive states like euphoria. If you just got a promotion and you're feeling on top of the world, that is a terrible time to buy a house or a car. You are high on success, and you will overestimate your future income and underestimate the risks. If you just had a fight with your spouse or you're exhausted from a long week, do not look at your budget and do not log into your brokerage account. Your willpower is depleted and you are vulnerable to impulsive choices. Adopting a simple rule can save you thousands of dollars. The 24-hour rule. If you want to buy something significantly expensive, or if you want to make a major change to your investment portfolio, you must wait 24 hours, no exceptions. If it's a good decision today, it will still be a good decision tomorrow. But in those 24 hours, your cortisol will flush out, your adrenaline will settle, and your prefrontal cortex, the logical, rational part of your brain, will come back online. You cannot surgically remove your survival instincts. You will always feel fear when the market drops. You will always feel the itch to spend what you have. The goal isn't to stop feeling. The goal is to stop acting on those feelings. Your brain is wired to survive, not to thrive financially. It prioritizes safety and immediate consumption. But now that you know the biological machinery running in the background, you can choose to override it. But our biology doesn't just mess with our emotions, it messes with how we process information. We love to be right, and we hate to be wrong, and that leads us into one of the most intellectually crippling traps in existence. Your brain is wired to survive, not to thrive financially. Let's dismantle the specific mental traps in Chapter 3. Chapter 3. Confirmation Bias and Echo Chambers. Have you ever noticed that the moment you buy a specific car, you suddenly start seeing that exact car everywhere on the road? Or when you decide that a certain stock is going to crash, every news headline seems to confirm your suspicion? You aren't suddenly psychic, and the world didn't change to match your thoughts. What changed is your filter. We all like to believe we are objective judges of reality. We think we look at the facts and then form an opinion. But biologically, we usually do the exact opposite. We form an opinion first, often instantly and emotionally, and then we go out and hunt for facts that support what we already believe. This is called confirmation bias. It is the brain's addiction to being right. In the financial world, confirmation bias is a portfolio killer. If you are bullish on a company, your eyes will gloss over the bad earnings report and zoom in on the one sentence about future growth. You will dismiss negative analysis as FUD, fear, uncertainty, and doubt, and you will embrace positive analysis as insight. You end up creating a fantasy world where you are always right, right up until the moment you lose your money. And in the modern age, this problem has been weaponized by technology. The algorithm does not care what is true. It only cares about what keeps you looking. If you click on a video titled, "Why Crypto is the Future," the algorithm learns that this content keeps you engaged. It will then feed you 5 more videos about why crypto is amazing. It will hide the videos that discuss regulatory risks or technical flaws. You essentially build a digital echo chamber. You find yourself surrounded by thousands of strangers who all agree with you. This creates a false sense of certainty. You think everyone knows this stock is going to skyrocket. But everyone is just the slice of the internet the algorithm has curated for you. This is how bubbles form. People get trapped in positive feedback loops where they only hear bullish arguments. They borrow money to invest because it feels like a sure thing. But when the bubble bursts, they are blindsided because they literally never saw the warning signs. The algorithm filtered them out. To protect your wealth, you have to fight the algorithm. You have to consciously step out of the echo chamber. If you find yourself nodding along to every piece of financial content you consume, you are in a dangerous spot. Comfort is the enemy of growth. So, how do we break this cycle? We steal a technique from the military and cybersecurity experts called red teaming. In a military war game, the red team is the group assigned to play the enemy. Their only job is to find holes in the blue team's defense. They attack, they probe, and they try to destroy the plan. You need to red team your own financial decisions. Before you make a significant investment, I want you to try to destroy your thesis. Don't look for reasons why it will work. Look for reasons why it will fail. If you want to buy a rental property, don't just look at the rental income calculators. Force yourself to write down the bear case. What happens if the major employer in the town leaves? What happens if the roof collapses next year? What happens if interest rates stay high for a decade? Go find the smartest person you can find who disagrees with you. If you think gold is a great investment, go read the arguments of someone who thinks it's a useless rock. Don't read them to mock them, read them to understand them. If you can read the strongest counter-argument against your position and still feel confident, then you have a solid thesis. But if you find yourself avoiding the counter-arguments because they make you uncomfortable, that is your brain trying to protect a fragile belief. That discomfort is a warning sign. Listen to it. Seeking disconfirmation evidence. The great investor Charlie Munger once said, "I never allow myself to have an opinion on anything that I don't know the other side's argument better than they do." Most people seek confirmation evidence. They type, "Why company X is a good buy" into Google. You need to become a hunter of disconfirming evidence. You should type, "Why company X will go bankrupt" into Google. This is painful. No one likes to hear that their brilliant idea might be stupid. It hurts our ego. But in finance, your ego is an expense item. You can either be right or you can be rich, but you rarely get to be both if you insist on ignoring reality. The goal of research is not to feel good, it is to find the truth. When you actively seek out information that contradicts your beliefs, you are stress testing your financial future. If your investment idea collapses the moment it meets a hard question, it's better that it collapses on paper before you put your life savings into it. So here is your homework for this chapter. Look at your largest investment right now. It could be your house, a specific stock, or even your career path. Now, spend 20 minutes aggressively looking for evidence that you are wrong. If you can survive that process, your conviction will be real. You won't need an echo chamber to tell you you're smart because you will have done the work. But what happens when you do the work? You make the investment and then it starts to go wrong. That brings us to the hardest psychological hurdle in finance: admitting defeat. You've learned to question your sources. Next, we tackle the expensive trap of holding on too long. Chapter 4. The Sunk Cost Fallacy. Imagine you bought a ticket to a concert for a band you used to love. It cost you $100. But on the night of the show, a terrible storm hits. It's pouring rain, you have a splitting headache, and frankly, you don't even listen to that band anymore. Do you go? Most people say, well, I have to go. I already spent $100 on the ticket. If I stay home, I wasted the money. So, you go. You stand in the rain, you get sick, you have a miserable time, and you hate every minute of it. This is the sunk cost fallacy in action. The $100 was gone the moment you bought the ticket. It was sunk. Your choice on the night of the concert wasn't between losing $100 or getting your money's worth. Your choice was between being miserable in the rain for free or being warm and comfortable at home for free. The money was already irrelevant. By going, you didn't save the money, you just added physical misery to the financial loss. Now, let's look at your portfolio. How many times have you stared at an investment that is down 40 or 50% and whispered to yourself, I can't sell now, I have to wait until it gets back to even? This is the most expensive lie in finance. The market does not know what price you paid. The market does not care about your break-even point. The stock does not owe you your money back. By holding on to a bad asset simply because you spent money on it in the past, you are standing in the rain with a headache, refusing to go home. In this chapter, we are going to learn the art of cutting losses. We are going to learn how to stop throwing good money after bad. Separating emotional investment from financial investment. The reason the sunk cost fallacy is so powerful is that it isn't really about math, it's about pain. When you sell an investment at a loss, you have to admit two things. First, that you lost money, and second, that you were wrong. As long as you hold on to the asset, the loss feels theoretical. You can tell yourself, it's just a paper loss. It'll come back. You can protect your ego. You can delay the pain. But the moment you sell, the loss becomes real. It stings. But here is the reality check. The loss is already real. If you bought a stock for $1,000 and it is now worth $500, you are worth $500, period. Your net worth has already dropped. Refusing to sell doesn't save your wealth, it just traps your remaining capital in a sinking ship. You have to separate your emotional investment, your pride, your hope, your refusal to admit defeat, from the financial investment. Think of your capital like employees in a business. If an employee is toxic, lazy, and losing the company money, do you keep them on the payroll just because you spent a lot of money training them 3 years ago? No. You fire them and you hire someone who can do the job. Your dollars are your employees. If they are trapped in a dead investment, they can't work for you. You need to fire the bad investment so you can free up that capital to go work somewhere else where it can actually grow. the zero-based budgeting approach. So, how do we know when to hold and when to fold? I want to give you a powerful mental tool called the overnight test. I want you to look at your current investment portfolio. Look at every stock, every bond, every piece of real estate. Now, imagine that tonight, while you sleep, a glitch in the banking system automatically sells everything you own and turns it into cash. You wake up tomorrow morning with zero investments, but a pile of cash in your account equal to the current value of your portfolio. Here is the question. Would you go out and buy those exact same assets in those exact same amounts at today's prices? If the answer is yes, absolutely, these are great bargains at these prices, then great, keep them. You're holding them because of their future potential, not their past cost. But if the answer is no way, I wouldn't buy that company today, then why do you own it? If you wouldn't buy it today, you shouldn't hold it today. This is called zero-based thinking. It forces you to evaluate every asset based on its current merit and future opportunity, completely ignoring what you paid for it. It strips away the history and leaves only the logic. If you apply the overnight test to your losers, you will often find that you wouldn't dream of buying them again. That is your clear signal to sell. Now, does this mean you should sell everything the moment it drops? Of course not. That's panic selling, and we covered that in Chapter 2. So, what is the difference between cutting a loss and panic selling? It comes down to your thesis. Remember the decision journal we talked about? This is where it saves you. When an investment goes down, go back to your journal. Read the reason why you bought it. If you bought a company because they had a competitive advantage in a specific technology, and suddenly a competitor released a better technology that made them obsolete, your thesis is broken. The reason for owning it no longer exists. In this case, the price drop is a signal of fundamental failure. You must pivot. You must sell. However, if you bought a company because it has a great long-term growth trajectory and the price dropped because the whole market is down due to a temporary geopolitical scare, but the company itself is still healthy, then your thesis is still intact. This is when the price drop is not a failure, it's a discount. This is when you persevere. The sunk cost fallacy happens when you hold on despite the thesis being broken. It happens when you change your story. You started buying it for growth, but now you're holding it just until it bounces back. That is hope, not strategy. Learning to take a small loss is a superpower. It protects you from the catastrophic loss. The investor who refuses to lose a little bit eventually loses everything. It hurts to click that sell button when you're in the red. It hurts to admit you were wrong. But your loyalty should be to your financial future, not to your past mistakes. Clear the dead wood from your portfolio. Free up your mental energy and your capital for opportunities that actually make sense today. Letting go is hard, but predicting the future is harder, unless you think in probabilities. Let's explore that next. Chapter 5. Thinking in Probabilities. When you look at an investment, or even a major life decision like taking a new job, what is the first question you ask? If you are like most people, you ask, is this going to work? Will this stock go up? Will this house appreciate in value? Is this crypto the next Bitcoin? You are looking for a yes or a no. You are thinking in binary terms. You want the world to be black and white. You want certainty. But here's the uncomfortable truth. The world is not black and white. It's a million shades of gray. And in the financial markets, certainty does not exist. There is no such thing as a sure thing. There are only probabilities. If you walk into a meeting with a professional investor and ask, will this stock go up? They will look at you like you're crazy. They know they can't answer that. Instead, they ask, what is the probability of this stock going up? And if it does, how much will we make? This shift from thinking in outcomes to thinking in probabilities is the single biggest leap you can make in your financial maturity. It changes you from a fortune teller trying to predict the future into a risk manager preparing for multiple futures. Understanding expected value. To think like a pro, you need to understand a concept called expected value, or EV. It sounds technical, but it's actually quite simple. Expected value is the sum of all possible outcomes weighted by how likely they are to happen. Let me give you a simple example. Suppose I offer you a bet. We flip a coin. If it lands on heads, I pay you $10. If it lands on tails, you pay me $1. Should you take the bet? Your brain might say, well, there's a 50% chance I lose money. I don't want to lose money. That's binary thinking. But a probabilistic thinker looks at the expected value. You have a 50% chance of winning $10. That's worth $5. You have a 50% chance of losing $1. That's a cost of 50 cents. So the expected value of this bet is $4.50 positive. If you play that game once, you might lose. You might get tails. But if you play that game 100 times, you are guaranteed to make a fortune. In investing, you were looking for positive expected value. You were looking for situations where the potential reward multiplied by the probability of success is significantly higher than the potential risk. This means you can make a good decision and still lose money on a single trade, just like you could flip tails in our game. But if you consistently make positive EV decisions, the math ensures that over 5 or 10 years, you will come ahead. You stop worrying about being right every single time and start focusing on having the math on your side over the long run. The myth of certainty. So if thinking in probabilities is so powerful, why doesn't everyone do it? Because it's exhausting and, frankly, it's scary. Our brains crave certainty. We want to be told everything will be okay. This is why financial news channels are filled with pundits screaming, "The market is crashing," or "Buy this now." They sound certain, they sound confident, and confidence sells. If a pundit went on TV and said, well, there's a 60% chance the market will rise, but a 40% chance it will fall due to inflation, nobody would watch. It sounds wishy-washy. But listen closely. Certainty in finance is a marketing myth. It is a product sold to anxious people. The moment you hear someone speaking with 100% certainty about the future price of an asset, you should stop listening. They are either a liar or they are delusional. Great investors, the ones who survive for decades, are incredibly humble. They use words like maybe, possibly, likely, and risk. They know that a single geopolitical event, a natural disaster, or a technological breakthrough can change the math instantly. When you accept that you cannot know the future for sure, you stop looking for gurus. You stop looking for the magic bullet. You start looking for odds. You start saying, I don't know what will happen, but I like my chances. Building a decision tree. So how do we apply this practically? You can't exactly run a complex mathematical formula every time you buy groceries, but for big decisions, buying a house, changing careers, or making a large investment, you should build a decision tree. Instead of asking, will this happen, map out 3 potential futures: the bull case, the base case, and the bear case. Let's say you were thinking of buying a rental property. Scenario 1 is the bull case. The area booms, you get great tenants who never leave, and the property value skyrockets. Assign a probability to this. Be honest. Maybe it's a 20% chance. Scenario 2 is the base case. The area stays about the same, you have average vacancy rates, and the value grows with inflation. This is usually the most likely outcome, let's say 50%. Scenario 3 is the bear case. The major employer in town leaves, the house needs a new roof, and you can't find a tenant for 6 months. Assign a probability, let's say 30%. Now look at that bear case. Can you survive it? If that 30% chance happens, will it bankrupt you? If the answer is yes, then it doesn't matter how good the bull case is. You can't take the bet. By mapping this out, you force yourself to look at the downside. Most people only fantasize about the bull case. They buy the house imagining the perfect tenant and the perfect appreciation. They ignore the 30% chance of disaster. Decision trees force you to live in reality. They force you to prepare for the worst while hoping for the best. This is the essence of critical thinking in finance. It is the ability to hold two opposing ideas in your head at the same time. This could make me rich, and this could go to zero. Once you start thinking this way, you realize that your job isn't to predict the future. Your job is to position yourself so that you win big if you're right and you don't die if you're wrong. You have the odds. Now you need to understand what you stand to lose. Chapter 6 covers the downside. Chapter 6: Asymmetric Risk and Reward. I want you to picture a common scenario. You see a $20 bill lying on the street in the middle of a busy intersection. Do you run out to grab it? Most of you would say, no, of course not. Why? Because the potential reward is $20, but the potential risk is getting hit by a bus. That is a terrible trade. The downside is infinite, death, while the upside is capped at $20. This is an extreme example of negative asymmetry. You are risking everything to gain almost nothing. It's what financial philosophers call picking up pennies in front of a steamroller. Yet in our financial lives, people make this trade every day. They chase a slightly higher yield on a sketchy bond, risking their entire principal for an extra 2% interest. They short a stock, where the most they can make is 100% if it goes to zero, but their potential loss is infinite if the stock skyrockets. To build wealth, you need to flip this equation on its head. You want positive asymmetry. You want situations where the risk is capped, known, and small, but the potential reward is uncapped and massive. Protecting the downside. The concept of ruin. The first rule of asymmetric thinking is surprisingly simple. Don't die. In investing, we call this avoiding ruin. Ruin doesn't just mean losing money. Ruin means being knocked out of the game, completely. It means losing so much of your capital or your confidence that you can no longer participate in the recovery. If you play a game where there is a 1% chance of ruin, meaning you lose everything, it doesn't matter how much money you make in the other 99% of outcomes, because eventually, if you keep playing, that 1% will hit you. And when it does, you are done. The probability of you going bust approaches 100% over time. This is why the most successful investors, like Warren Buffett, are obsessed with safety. Buffett's famous 2 rules are: Rule number 1, never lose money. Rule number 2, never forget rule number 1. He isn't saying you should never have a red day. He is saying never take a risk that could wipe you out. The math behind this is brutal. If you lose 50% of your portfolio, you don't need a 50% gain to get back to even. You need a 100% gain. If you start with $10,000 and lose half, you have $5,000. To get back to $10,000, you have to double your money. That is incredibly hard to do. This is why protecting your downside is mathematically more important than maximizing your upside. If you avoid the big losses, the compounding takes care of the rest. If you take a hit that wipes you out, the game is over. So, how do we find these magical asymmetric opportunities? We look for capped risk and uncapped potential. Let's look at a simple example. Starting a side business. What is the risk? Maybe you lose a few $1,000s in setup costs. Maybe you lose your weekends for a few months. The risk is capped. You know exactly what you stand to lose, and it won't bankrupt you. But what is the potential reward? If the business takes off, it could replace your salary. It could be sold for millions. The upside is uncapped. Compare that to buying a safe corporate bond that pays 5%. The upside is capped. You will only ever get that 5%. But if the company goes bankrupt, you could lose 100% of your money. That is poor asymmetry. In your own portfolio, you want to structure your life around bets where the cost of being wrong is small, but the payoff of being right is huge. This applies to your career, too. Asking for a raise is an asymmetric bet. The risk is a few minutes of awkward conversation. The reward is thousands of dollars a year compounding for the rest of your life. The downside is uncomfortable. The upside is life-changing. Always ask yourself, if I'm wrong, how much do I lose? And if I'm right, how much do I win? If the win isn't at least 3 or 4 times the size of the loss, walk away. Why avoiding big losses is key. We live in a culture that celebrates the home run. We look at the guy who bet it all on a crazy idea and won. But for every one of those guys, there are 100 who struck out and went home broke. You don't need home runs to get rich. You just need singles and doubles, and crucially, you need to never strike out. Think about 2 investors. Investor A makes 20% one year, then loses 20% the next year, then makes 20%, then loses 20%. After 4 years, they are actually down money because of the math of loss recovery. Investor B is boring. They make 8% every year. They never lose. After 4 years, they are way ahead of Investor A. The big win is seductive, but the big loss is the killer. Your goal is to stay in the game. If you can stay in the game for decades, catching the average returns of the market without ever getting wiped out by a foolish risk, you will end up wealthy. It is inevitable. But if you chase the big asymmetric win without checking the downside, if you leverage your house to buy crypto or borrow money to trade options, you are inviting ruin into your life. The smartest risk management strategy is simply asking, what is the worst thing that can happen here? If the worst thing is acceptable, then you can look at the upside. If the worst thing is catastrophe, you stop right there. Risk is what you don't see. To see further, you need to look past the immediate result, which we will do in Chapter 7. Chapter 7. Second-Order Thinking. There is a reason why grandmaster chess players beat novices every single time. It isn't because they have faster reflexes or better eyesight. It's because while the novice is looking at the piece they want to move right now, the grandmaster is looking at what the board will look like 5 moves after that. The novice thinks, if I take this pawn, I win a piece. That is first-order thinking. It focuses on the immediate result. The grandmaster thinks, if I take this pawn, I open up my king to an attack, which forces me to move my queen, which loses me the game. That is second-order thinking. It focuses on the consequences of the consequences. In personal finance, almost everyone is a first-order thinker. They ask, will this purchase make me happy right now? Or can I afford the monthly payment? If the answer is yes, they do it. They solve for the immediate desire. But wealth is not built in the immediate. Wealth is built in the second and third orders. The legendary investor Howard Marks says that first-order thinking is simplistic and superficial, and just about everyone can do it. But second-order thinking is deep, complex, and rare. And because it is rare, it is extremely profitable. Asking, and then what? To develop this superpower, you only need to learn 3 words. And then what? Let's apply this to a classic financial decision: buying a luxury car. First-order thinking says, I want this car. It looks amazing. I have the money for the down payment, and I can squeeze the monthly payment into my budget. I'm buying it. The immediate result is satisfaction and social status. Now let's apply second-order thinking. We ask, and then what? Well, because the car requires premium fuel and expensive maintenance, your monthly transportation costs double. And then what? Because your monthly costs are higher, you have less free cash flow to put into your investment account. And then what? Because you aren't investing that cash, you miss out on 10 years of compound interest. And then what? You have to work 3 extra years before you can retire just to pay for the car you bought 10 years ago and have already sold. Suddenly, that car isn't just costing you a monthly payment. It is costing you 3 years of your freedom. When you view the decision through this lens, the car looks very different. You aren't just buying metal and leather. You are trading away a slice of your future life. You can apply this to everything. If you take a higher-paying job that requires you to work 80 hours a week, first-order thinking sees the money. Second-order thinking sees the burnout, the health problems, and the divorce that might cost you half that money anyway. The long-term consequences of cheap debt. Nowhere is first-order thinking more dangerous than with debt. Our modern economy is designed to keep you trapped in first-order thinking. Buy now, pay later is the ultimate first-order trap. It screams, get the product now. That's the first order. The second-order effect is that you now have a recurring obligation. You have added friction to your life. The third-order effect is psychological. When you have payments dragging on your income, you become risk-averse. You can't quit the job you hate to start the business you love because you have to service the debt on the TV you bought 3 years ago. Cheap debt looks like a tool, but often it acts like an anchor. Let's look at student loans. First order, go to a prestigious, expensive college to get a degree. Result, a diploma and a great experience. Second order, you graduate with $100,000 in debt. Third order, you can't afford to buy a house in your 20s. You delay starting a family. You take a safe corporate job instead of a high-growth opportunity because you need the guaranteed paycheck to pay the bank. The decision you made at 18 dictates the life you live at 30. The first-order thinker sees the diploma. The second-order thinker sees the shackles. Before you take on any debt, even at a low interest rate, ask yourself, how does this obligation limit my options in the future? If the debt buys you an asset that pays you, like a rental property, the second-order effect is positive, more income. If the debt buys you a toy, the second-order effect is negative, less freedom. Anticipating ripple effects in the economy. Finally, we need to apply second-order thinking to the broader economy. When the news headlines scream about a major event, like the Federal Reserve raising interest rates, the first-order thinker panics. They think, stocks will go down. This is bad. The second-order thinker pauses and asks, who benefits from this? If rates go up, sure, borrowing becomes expensive, but it also means that savings accounts finally start paying interest. It means that speculative bubbles in risky assets might pop, making real assets cheaper to buy. If you only look at the immediate pain, you miss the subsequent opportunity. Consider the rise of remote work. First order, people don't have to commute. Office buildings go empty. Second order, commercial real estate crashes. City centers lose revenue. Third order, substance and value shift to the suburbs or rural areas. Home improvement stocks go up because people spend more time at home. Cybersecurity stocks go up because companies need to protect remote workers. While the crowd was busy selling their office REITs, real estate investment trusts, the second-order thinkers were quietly buying stock in cybersecurity and home builders. You don't have to be a psychic to do this. You just have to stop reacting to the headline and start thinking about the dominoes. Life is a chain reaction. Every financial decision you make sets off a sequence of events that extends years into the future. The person who relies on luck hopes the dominoes fall in their favor. The critical thinker arranges the dominoes so that no matter how they fall, they lead to a position of strength. You are now thinking steps ahead. You are looking past the immediate horizon. But to see clearly, you need to be able to filter out the massive amount of useless information that bombards you every day. You are now thinking steps ahead. Now, let's filter out the distractions that cloud your vision. Chapter 8. Signal versus Noise. We live in an age of information obesity. Every single day, you are bombarded with more financial data than a person in the 1950s encountered in a lifetime. You wake up and check your phone. A notification says inflation is up. Another says a tech CEO just tweeted something cryptic. A YouTuber says the housing market is collapsing. Your coworker tells you about a hot new stock. It feels like you are staying informed. It feels like you are being responsible. But in reality, you are drowning in noise. In engineering, the signal-to-noise ratio compares the level of a desired signal to the level of background noise. If the noise is too loud, you can't hear the message. In finance, the signal is the information that actually matters for the long-term value of your investments. The noise is everything else. Here is the brutal truth. 99% of financial news is noise. It is designed to trigger your emotions, keep you clicking, and keep you watching ads. It is not designed to make you wealthy. In fact, consuming too much of it is actively making you poorer. In this chapter, we are going to turn down the volume. We are going to learn how to ignore the distraction and focus on the data that actually moves the needle. Identifying noise. How do you tell the difference between signal and noise? The signal is durable. The noise is temporary. If a company reports its quarterly earnings and they missed the target by 1 penny, the stock might drop 5% that day. The news headlines will scream, "Company X plummets." That is noise. Why? Because the fundamental value of a business does not change by 5% in a single day based on a penny difference. The price changed, but the value remained largely the same. The signal would be something deeper. Is the company losing market share to a competitor? Is their technology becoming obsolete? That is information that matters for the next 10 years. A simple test you can use is the 5-year test. When you read a headline, ask yourself, will this matter in 5 years? Stock market drops 2% on Tuesday. Will that matter in 5 years? No, it's noise. Federal Reserve changes long-term interest rate policy. Will that matter in 5 years? Yes, it impacts the cost of capital for everyone. That is signal. Most investors spend all their energy reacting to things that won't matter next month, let alone next decade. They are like a captain of a ship steering into every tiny wave instead of looking at the lighthouse on the horizon. If you react to noise, you will overtrade. You will incur taxes and fees. You will sell good assets because of bad headlines. To be a critical thinker, you must be comfortable with boredom. Real investing is often very boring. If it's exciting, you're probably gambling. The high cost of checking your portfolio. One of the most destructive habits you can have is checking your portfolio every day. I know it's tempting. It gives you a sense of control, but it is an illusion. You cannot control the market by looking at it. Here is what happens when you check daily. You expose yourself to volatility. The market goes up and down constantly. If you look every day, you see every dip. You feel the pain of every loss. Remember the biology we talked about? Every time you see red, your amygdala fires. You feel stress. You feel the urge to fix it. This leads to tinkering. You sell a little here, buy a little there, trying to smooth out the ride. But if you check your portfolio once a quarter or once a year, you miss all that interim volatility. You might see that the market is up 8% for the year. You feel good. You didn't feel the panic of the 10% drop that happened in March because you weren't looking. Nassim Taleb, the author of The Black Swan, explains that the more frequently you look at data, the more likely you are to see noise rather than signal. Over 1 hour, the market is random. Over 1 year, it shows a trend. Over 10 years, it reflects economics. Stop looking at the random movements. Delete the stock ticker app from your phone. If you are a long-term investor, the daily price is irrelevant. You are buying a house to live in for 20 years. Why are you checking the Zestimate every morning? Curating a high-quality information diet. You are what you eat. If you eat junk food, your body gets sick. The same is true for your mind. If you consume junk information, your financial health suffers. Most people consume a diet of fast news, tweets, 24-hour cable news, and clickbait articles. These are high in emotional calories, but low in nutritional value. You need to go on an information diet. First, cut the cord on financial news TV. These channels have 24 hours to fill every day. They have to manufacture drama where there is none. They bring on guests who make extreme predictions because extreme predictions get ratings. It is entertainment, not education. Second, curate your inputs. Follow people who have a track record of being right over decades, not just the last 6 months. Read the source material. Don't read an article about a company's earnings. Read the earnings report itself. Don't read a tweet about inflation. Look at the data from the Bureau of Labor Statistics. Third, read something old. This is known as the Lindy effect, the idea that the longer something has survived, the longer it is likely to survive. A book on investing written 50 years ago that is still in print is likely to contain timeless wisdom. A blog post written this morning is likely to be forgotten by tomorrow. Spend your time reading about history, psychology, and business strategy. Learn how the world works, not just what the market did today. When you clear away the fog of daily noise, you can finally see the path ahead. You stop reacting to the wind and start adjusting your sails. You become calm while everyone else is freaking out. And once you have that clarity, you can harness the most powerful mathematical concept in the universe. It's the engine that turns small, consistent actions into massive wealth. With a clear mind, we can now look at the strongest force in the universe. It's compounding. Chapter 9. The Logic of Compounding. I want to start with a question that sounds like a riddle. If you could take a standard piece of paper about the thickness of a human hair and fold it in half 42 times, how thick would the resulting stack be? Most people guess it would be a few feet high, maybe as tall as a refrigerator, or if they're feeling bold, maybe as tall as a building. The answer is that it would reach the moon. If you folded it 50 times, it would reach the sun. This sounds impossible. It feels wrong. Your brain wants to reject it. And that is exactly the point. The human brain is wired for linear thinking. We understand 1, 2, 3, 4. If you take 30 steps linearly, you get 30 meters away. But compounding is exponential. It goes 2, 4, 8, 16. If you take 30 exponential steps, you circle the Earth 26 times. This inability to intuitively grasp exponential growth is the reason why so many people give up on investing and why so many people underestimate how wealthy they could actually become. In this chapter, we're going to explore the logic of compounding. It's not just a financial concept, it's the fundamental physics of success. The hockey stick growth curve. Imagine a graph. The line starts at the bottom left and moves to the right. For a long time, it looks almost flat. It inches up so slowly that it seems like nothing is happening. This is the blade of the hockey stick lying on the ice. Then, suddenly, the line turns upward and shoots vertically toward the sky. That is the handle. Here's the tragedy of the average investor. They quit while they're still on the blade. They invest for 2 or 3 years. They sacrifice, they save, they skip the expensive vacations, and they look at their account balance and think, is this it? All that effort for this tiny gain? They get discouraged. They pull the money out for a car, or they stop contributing. They stop right before the curve bends. You have to understand that in a compounding system, the vast majority of the results come at the very end. Warren Buffett is currently worth over $100 billion, but here's a startling fact. He accumulated more than 90% of that wealth after his 65th birthday. He didn't get those results because he suddenly became a better investor in his old age. He got those results because he had been letting his money compound for 70 decades. The massive numbers you see today are just the physics of the handle of the hockey stick kicking in. If you're in your 20s, 30s, or 40s, you're likely still on the blade. It feels like a grind. It feels slow. But you're building the foundation for the vertical ascent. You have to trust the math more than you trust your feelings. Now, this principle doesn't just apply to your bank account. It applies to your skills, your health, and your relationships. If you read 10 pages of a book every day, in one day, you haven't learned much. In a week, you've read a chapter. But in a year, you've read 12 books. In 10 years, you've read 120 books. You have accumulated a level of wisdom and pattern recognition that makes you unrecognizable compared to who you were when you started. This is the law of atomic habits. Small, consistent improvements, just 1% better every day, don't just add up, they compound. Think about professional networking. You help one person today, nothing happens. You help another person next month, nothing happens. But over 10 years, you build a reputation as someone who is helpful and competent. Suddenly, an opportunity comes to you seemingly out of nowhere. It wasn't out of nowhere. It was the compounded result of 1,000 small interactions. The same is true for the negative side. If you eat slightly too much sugar every day, you don't get sick tomorrow, but the negative effects compound over 20 years until you have a chronic illness. You're always compounding something. The question is, are you compounding errors or are you compounding wisdom? Are you compounding debt or are you compounding wealth? The illusion of stagnation. The hardest part of compounding is the beginning. We call this the valley of disappointment. This is the period where your effort is high, but your visible results are low. It feels like you're shoveling coal into a furnace that gives off no heat. Let's look at the math of a savings account. If you save $10,000 and it earns 10% interest, after 1 year you have $11,000. You made $1,000. That's nice. But it's not life-changing. It won't even buy you a nice laptop. Fast forward, let's say you keep that up for 30 years. In the 30th year alone, that same account might grow by $100,000 or more. Same interest rate, same strategy, but a completely different outcome. In the beginning, you work for your money. In the end, your money works for you. But to get to the end, you have to survive the beginning. You have to be willing to be bored. You have to be willing to look at your account and see small numbers for a long time. This requires a shift in identity. You can't be the person who needs immediate validation. You have to be the person who takes pride in the process. You have to get your dopamine hit from the act of saving, not from the size of the account. If you can stay consistent when it feels like nothing is happening, you are winning. You are quietly folding the paper. You are building the pressure that will eventually explode upward. But here's the warning. Compounding is the strongest force in the universe, but it is also fragile. It requires one thing above all else: uninterrupted continuity. If you interrupt the process, if you panic and sell, or if you get wiped out by a disaster, you reset the clock. You go back to the beginning of the curve. To harness compounding, you don't need to be brilliant. You just need to survive. You need to make sure you are never forced to sell at the wrong time. You need a defense system. Compounding builds wealth, but a single disaster can destroy it. Chapter 10 builds your defensive wall. Chapter 10: The Margin of Safety. In the late 19th century, when engineers built the first Brooklyn Bridge, they didn't calculate the exact weight of the traffic it would carry and build it to support exactly that amount. They calculated the maximum possible load, and then they built the bridge to support 6 times that weight. They didn't do this because they liked wasting steel. They did it because they were smart. They knew that steel might be flawed. They knew that winds might be stronger than recorded history. They knew that someday heavier trucks might be invented that they couldn't even imagine. They built in a margin of safety. Because of that margin, the bridge is still standing over 100 years later. In your financial life, you are the engineer. But most people build their financial bridges with no margin for error. They spend exactly what they earn. They assume they will always have a job. They assume the market will always go up. They build a bridge that can support exactly the weight of a sunny day. But life is not always sunny. Recessions happen. Pandemics happen. You get sick. The furnace breaks. If you have no margin of safety, a single crack in the system causes the entire bridge to collapse. In this chapter, we are going to stop trying to predict the storm, and instead, we are going to build a house that can withstand the hurricane. Emergency funds as psychological insurance. Let's talk about the most basic form of safety, the emergency fund. Most financial advisors tell you to keep 3 to 6 months of living expenses in cash. That's good advice, but they usually explain it wrong. They tell you it's for paying bills if you lose your job. While that's true, the real purpose of an emergency fund is not financial, it is psychological. When you have $0 in the bank and your car breaks down, you are desperate. You have to fix the car to get to work, so you put it on a high-interest credit card, or you cash out your 401k and pay a penalty, or you take a predatory payday loan. Desperation forces you into terrible decisions. It forces you to be a first-order thinker. You solve the immediate problem by creating a disaster for your future self. But when you have $20,000 sitting in a boring savings account, a broken car is not a crisis. It is an inconvenience. You write a check, you fix the car, and you move on. You don't touch your investments. You don't interrupt the compounding curve. You don't panic. Cash is the oxygen of independence. It buys you the ability to say no. If you have a year of expenses saved and your boss becomes abusive, you can quit. If you have no savings, you have to stay and suffer. Do not look at your emergency fund as an investment that is losing to inflation. That is the wrong frame. Look at it as an insurance premium that you pay to yourself to protect your mind from panic. The return on investment of that cash is the bad decisions you didn't make. Avoiding leverage. If cash is the creator of safety, leverage is the destroyer of it. Leverage, borrowing money to invest, is the only way a smart person can go broke. If you buy a stock with cash and it drops 50%, you still own the stock. You can wait for it to recover. But if you buy that stock with borrowed money, margin, and it drops 20%, the bank calls the loan. They sell your stock at the bottom to cover their debt, and you are left with nothing. Leverage reduces your margin of safety to zero. It is like driving a car with a sharp metal spike sticking out of the steering wheel, pointing at your chest. As long as the road is smooth, you might get to your destination faster, but if you hit one pothole, one unexpected bump, you are dead. During the great financial crisis of 2008, millions of people lost their homes not because the homes were worthless, but because they were leveraged. They had mortgages they couldn't afford when the teaser rates expired. They had no room for error. To be anti-fragile, you must respect the power of debt. Avoid it for anything that isn't a cash-flowing asset. If you use debt for real estate, ensure you have a massive cash buffer to pay the mortgage if the property sits empty. Never bet the farm. Never put yourself in a position where a temporary drop in prices forces you out of the game completely. Remember, to finish first, you must first finish. Building redundancy. In engineering, redundancy means having a backup system. If one engine on the airplane fails, the other one can still land the plane. In your financial life, you need redundancy. Look at your income. For most people, their income has a single point of failure. It is their job. If that one paycheck stops, the entire system crashes. That is a fragile bridge. To build a margin of safety, you need to diversify your income streams. This doesn't mean you need to work 3 jobs. It means you need to build assets that pay you. Maybe it's a dividend portfolio that covers your electric bill. Maybe it's a side hustle that covers your groceries. Maybe it's a rental property. When you have multiple streams of income, the loss of your main job is no longer a catastrophe. It is just a loss of one engine. You can still fly. You also need redundancy in your skills. If you're a specialist in a dying industry, you are vulnerable. You need to be a continuous learner, constantly adding new tools to your belt so that if the market shifts, you can shift with it. And finally, you need redundancy in your optimism. You need to save like a pessimist, assuming the world will break, so that you can invest like an optimist, knowing the world will eventually get better. The margin of safety is not about being scared. It is about being prepared. It is the confidence that comes from knowing that no matter what the economy throws at you, you have the buffer to absorb the shock. Once you have built this fortress, once you have the cash, the lack of bad debt, and the redundant income, you are no longer playing defense. You are free to play offense. You can look at the market not with fear, but with a calculator. Your defense is set. Now let's talk about the tools you use to attack the market. Chapter 11. Opportunity Cost and Valuation. There is a hidden price tag on everything you buy, and it is usually much higher than the sticker price. Let's say you walk into a dealership to buy a car. The sticker says $40,000. You have $40,000 in the bank. You write the check. You think the car cost you $40,000, but it didn't. If you had taken that $40,000 and invested it in a boring index fund earning an average of 8% a year, in 30 years, that money would have grown to over $400,000. So the real cost of the car wasn't $40,000. It was $400,000 of your future net worth. This is the concept of opportunity cost. It is the value of the next best alternative that you forego when you make a choice.
In economics, there are no solutions, only trade-offs. Every time you say yes to one thing, you are automatically saying no to something else. The critical thinker understands that money has potential energy. When you spend it today, you dissipate that energy. When you invest it, you harness it. In this chapter, we're going to learn how to price your life correctly. We're going to look at the invisible ledger that tracks what you gave up to get what you have. Calculating the real cost of capital. To master this, you need to think like a CEO. Every company has a cost of capital. If a company wants to build a new factory, they don't just ask, "Do we have the cash?" They ask, "If we spend this cash on the factory, we can't spend it on marketing or R&D or buying back stock. Will the factory earn more money than those other options?" If the factory returns 5%, but a marketing campaign would return 20%, building the factory is a mistake, even if it's profitable. It is a mistake because it is an inefficient use of capital. You are the CEO of your own life. You have a limited amount of capital. Before you make a significant purchase or investment, you need to calculate your hurdle rate. This is the return you could get with zero effort. For most people, this is the long-term return of the stock market, roughly 8 to 10%. So, if someone pitches you a real estate deal that will return 6% a year, but it requires you to fix toilets and chase tenants, that is a bad deal. Why would you work hard for 6% when you can do nothing and get 8%? The opportunity cost of the money and your time makes the deal a loser. You need to view every dollar in your pocket as a seed. You can eat it now, or you can plant it. If you eat it, you satisfy your hunger for an hour. If you plant it, it grows a tree that feeds you for a lifetime. The valuation of the seed is not just its nutritional content today, it is the forest it could become tomorrow. Time as the ultimate currency. But opportunity cost isn't just about money. It is about the one asset you can never earn back: time. We often trade time for money without doing the math. Imagine you drive 20 minutes out of your way to save $10 on a tank of gas. You feel smart. You beat the system. But let's do the valuation. You spent 40 minutes round trip to save $10. That means you valued your time at $15 an hour. If you earn $50 an hour at your job, you just made a terrible trade. You essentially paid the gas station for the privilege of wasting your time. This applies to housing, too. People often move to the distant suburbs to save money on rent or a mortgage. They save $500 a month, but they add an hour to their commute each way. That's 10 hours a week, 40 hours a month. They are selling 40 hours of their life, 40 hours they could spend with their kids, exercising, or building a side business for $500. That values their free time at $12.50 an hour. Is your life worth $12.50 an hour? A critical thinker values their time at a premium rate. They pay for convenience if it frees up time for high-value activities. They hire a cleaner, not because they're lazy, but because the hour they save is worth more than the cost of the cleaner. Always ask, what am I giving up to get this? If the answer is hours of my life, the price is likely too high. Finally, we need to apply valuation to our investments. How do you decide between a stock, a bond, a piece of real estate, or a crypto token? You can't just look at the price tag. You have to look at the value. The most common mistake amateur investors make is confusing cheap with value. A stock trading at $5 is not necessarily cheaper than a stock trading at $500. The $5 stock might be a company that's going bankrupt. The $500 stock might be a money printing machine. Valuation is the art of determining what an asset is actually worth, independent of its current price. Think of it like buying a cow. You don't buy a cow because it looks pretty, you buy it for the milk. You calculate how much milk it will produce over its lifetime, subtract the cost of feeding it, and that is the value of the cow. If the farmer asks for $1,000, but the cow will only produce $500 worth of milk, it is overvalued. You shouldn't buy it, even if your neighbor just bought one for $2,000. In stocks, the milk is the cash flow the company generates. In real estate, it's the rent. When you look at an asset, let's say a hyped-up tech stock or a trendy cryptocurrency, ask yourself, where is the milk? If the asset generates no cash flow and never will, you aren't investing, you're speculating. You are hoping that someone else will pay more for the cow later, even though it produces nothing. That is the greater fool theory. True valuation requires you to be objective. It requires you to say, I love this company's product, but at this price, the math doesn't work. It requires the discipline to sit on your hands and wait until the price matches the value. This is difficult because the market often stays irrational for a long time. You will watch your friends make money on overvalued garbage while you sit on the sidelines. You will feel stupid. But remember the tortoise and the hare. The person who respects valuation survives. The person who chases price eventually runs off a cliff. You know things cost. Now let's analyze the psychology of the crowd you're competing against. Chapter 12. Contrarian Thinking. There is a famous saying in the investment world. If you want to have a better performance than the crowd, you must do things differently from the crowd. It sounds obvious. It sounds easy. But in practice, it is one of the hardest things a human being can do. Imagine you are at a dinner party. Everyone is talking about how much money they made on the latest tech stock. They're high-fiving, they're planning their vacations. You are the only one who hasn't bought in. In fact, you think the stock is dangerously overvalued. Do you speak up? Do you tell them they are walking into a trap? Or do you stay silent? Or worse, do you feel the pressure, pull out your phone, and buy the stock just to be part of the group? If you buy, you are following the herd. And in financial markets, the herd is right in the middle, but they are almost always wrong at the extremes. To build exceptional wealth, you have to become a contrarian. You have to be willing to buy when everyone else is selling, and sell when everyone else is buying. You have to be willing to look like an idiot in the short term to be a genius in the long term. Reading market sentiment indicators. The market is not a calculator, it is a mood ring. It reflects the collective psychology of millions of people. To be a contrarian, you need to know how to read the room. You need to identify when the room is too happy or too scared. One of the most reliable indicators is the shoeshine boy theory, famously attributed to Joe Kennedy before the 1929 crash. He said that when the shoeshine boy started giving him stock tips, he knew it was time to get out. Why? Because if the shoeshine boy is fully invested, there is no one left to buy. In the modern era, we have the Uber driver indicator. If your driver, your barber, and your dentist are all telling you to buy a specific cryptocurrency or stock, that is a flashing red warning light. When an asset becomes a topic of polite conversation for people who don't do this for a living, it usually means we are near the top. The optimism is priced in. Everyone who wants to buy has already bought. The only direction left is down. Conversely, look for what people hate. Look for the asset classes that make people cringe. If you mention an investment and people say, "Ugh, why would you buy that? That industry is dead," take a closer look. When the headlines are universally negative, the end of real estate, why stocks are doomed, That is often the moment of maximum opportunity. Pessimism brings prices down. Euphoria drives prices up. As a value hunter, you want low prices, which means you need to be best friends with pessimism. The difficulty of standing alone. Now, you might think, okay, I'll just wait for everyone to be scared and then I'll buy. But you are underestimating your own biology. We evolved in tribes. 50,000 years ago, if you were separated from the tribe, you died. Your brain equates social isolation with death. When you sell while everyone is buying, you are isolating yourself. You are breaking the social contract. Your brain will scream at you. You will feel physical anxiety. You will question your sanity. You will think, is it possible that everyone else is right and I am the only one who is wrong? This is why bubbles go so high and crashes go so deep. Even the smart people eventually capitulate. They can't handle the FOMO, the fear of missing out. True contrarianism isn't just about being stubborn. It's not about disagreeing for the sake of disagreeing. That's just arrogance. Constructive contrarianism is about independent thinking. It means you look at the data, you run the valuation numbers we discussed in the last chapter, and if the math says buy, but the crowd says sell, you trust the math. You have to be comfortable being lonely. You have to be comfortable looking wrong for a while. As the investor Michael Burry, who predicted the 2008 housing crash, learned, you can be right on the data, but early on the timing. And while you are waiting for the world to catch up to your logic, you will be mocked. You need a thick skin to hold on to your conviction. Buying fear and selling greed. The legendary Warren Buffett summed up this entire philosophy in one sentence. Be fearful when others are greedy, and greedy when others are fearful. Think about Black Friday. When televisions are 50% off, people stampede into the store. They fight each other to buy. They love a discount. But when the market goes on sale, when prices drop 50%, people run out of the store. They scream, "Get me out!" It makes no logical sense. You should love a market crash. A market crash is the only time you can buy $1's worth of assets for 50 cents. When the market is bleeding and the news is terrible and your portfolio is down, that is the moment you need to summon your courage. That is the moment you deploy your cash. You are buying fear. You are providing liquidity to people who are desperate to get out, and in exchange, you are getting premium assets at bargain prices. And when the market is roaring, when everyone is celebrating, when your neighbor is bragging about his returns, that is when you should be terrified. That is when you should be trimming your positions, taking profits off the table, and building up your cash pile. You are selling greed. This requires an emotional discipline that most people simply do not have. Most people buy high because it feels safe and sell low because it hurts. You are going to be different. You are going to use the mood of the crowd as a contrarian signal. When they cry, you buy. When they yell, you sell. Standing alone requires a strong mental framework. You can't just rely on willpower, you need rules. You need a system that forces you to do the right thing even when you don't want to. Standing alone requires a strong mental framework. Let's build your personal operating system.
Chapter 13: Systems over Goals. I have a question for you. In the Olympics, what is the goal of every single athlete on the starting line? They all have the exact same goal, to win the gold medal, but only one of them wins. If the winner and the losers have the same goal, then the goal cannot be the thing that differentiates them. The goal is just a wish. The difference between the person on the podium and the person watching from home is not their desire to win, it is their system of training.
In finance, we are obsessed with goals. I want to be a millionaire by 40. I want to retire on a beach. I want a Lamborghini. These are fine aspirations, but a goal is just a destination. It doesn't tell you how to get there. And worse, relying on goals creates a binary form of happiness. You tell yourself, once I hit $1 million, then I will be successful. Until then, by your own definition, you are failing. This chapter is about shifting your focus. We are going to stop staring at the finish line and start looking at the machine that gets us there. We are going to choose systems over goals. Automating critical thinking decisions. The problem with relying on willpower is that willpower is a battery. It drains throughout the day. If you have to wake up every single month and make a conscious decision to save money, eventually you will fail. You will have a bad month, or you'll see a shiny new gadget, and your willpower will be empty. You will skip the contribution. A system eliminates the need for willpower. A system makes the good behavior automatic and the bad behavior difficult. The most basic financial system is automation. You shouldn't be deciding how much to save. Your bank account should do it for you before you even see the money. It should move from your checking account to your investment account on the day you get paid. But we need to go deeper. We need to automate your decisions. We talked earlier about how hard it is to buy when the market crashes. If you have to make that choice in the heat of the moment while the news is screaming recession, you probably won't do it. But what if you didn't have to choose? What if you set up an automatic escalation, a system that says, every year I increase my savings rate by 1%. You set it up once, and for the next 20 years, you get wealthier without ever thinking about it again. You are outsourcing your discipline to a robot. The robot doesn't have emotions. It doesn't have fear. It just executes the code. That is how you defeat your own biology. Creating if-then rules for your money. To build a robust operating system for your life, you need to write your own code using if-then statements. Computers run on this logic. If X happens, then execute Y. You can use this to pre-decide your reaction to stress and opportunity. Here's an emotional if-then rule. If I want to buy a luxury item over $500, then I must wait 72 hours. You don't have to debate with yourself in the store. You don't have to wonder if you can afford it. The rule is the rule. If it's over $500, you walk away. If you still want it in 3 days, you can buy it. Here's an investment rule. If my portfolio drops by 10%, then I will invest an extra $1,000 from my emergency cash. By deciding this now while you are calm, you remove the panic from the crash. When the drop happens, you don't freeze. You look at your rule book. Oh, the market is down 10%. The rule says I buy. You execute. This removes the cognitive load. You stop burning energy worrying about what to do because you have already decided. You are just the pilot following the flight plan you wrote before you took off. The fallacy of the finish line. Finally, we need to address the biggest danger of goal-oriented thinking, the yo-yo effect. We see this in dieting all the time. Someone has a goal, lose 20 pounds. They work hard, they starve themselves, and they hit the goal. They celebrate. And then what happens? They stop doing the things that got them there. They go back to their old habits. 6 months later, they have gained the weight back. The same happens with money. People sacrifice to hit a number. They hit it and they think, I made it, I'm rich. They loosen up. They start spending. They stop tracking. And slowly the wealth erodes. Wealth is not a finish line you cross. It is a garden you tend. If you stop watering the garden because you finished planting it, everything dies. A systems mindset understands that there is no finish line. You don't save money to get rich. You save money because you are the type of person who builds security. It is an identity, not a task. When you focus on the system, you win every time you execute the habit. Did you auto-invest this month? Yes, then you won today. You don't have to wait 10 years to feel good about yourself. You get the satisfaction of knowing your machine is running smoothly right now. Forget about the $1 million. Focus on the system that generates the $1 million. If the system is good, the goal will take care of itself. Your system is built, but even the best system can be shaken by a black swan event. What happens when the world changes unexpectedly? Your system is built, but what happens when the world changes unexpectedly? Let's discuss fragility.
Chapter 14. Antifragility in Finance. If you mail a package filled with crystal wine glasses, you write "fragile" on the box. This tells the postman, if you drop this, it breaks. If you mail a package filled with books, you don't need a label. If you drop it, nothing happens. The books are robust or resilient. They withstand the shock. But imagine a third type of package. Imagine a box that when you drop it, the contents actually get better. The more you shake it, the stronger it becomes. What word would you write on that box? Most people say strong or unbreakable, but those words just mean it doesn't break. They don't mean it improves. The philosopher Nassim Taleb coined a word for this. He calls it antifragile. Your bones are antifragile. If you put them under the stress of lifting weights, they get denser. Your immune system is antifragile. If you expose it to a virus, it learns and produces antibodies. Most people try to build a financial life that is merely resilient. They just want to survive the crash. I want you to aim higher. I want you to build a financial life that is anti-fragile, a system that actually benefits from volatility, chaos, and disorder. In this chapter, we are going to look at how to structure your money so that you don't just endure the storm, you use the energy of the storm to power your house. The barbell strategy. The most practical way to achieve antifragility is something called the barbell strategy. Picture a weightlifting barbell. All the weight is at the two extremes, and there is nothing in the middle. In finance, the middle is the danger zone. This is where most people live. They put all their money in medium-risk investments that supposedly offer medium returns. They buy corporate bonds or stocks that are considered safe, often using a bit of leverage. The problem is that the middle is fragile. It has limited upside. You'll never get rich off 5% returns, but it has hidden downside. In a catastrophic crash, those safe investments can lose 40% or 50% of their value. You risk a lot to make a little. The antifragile investor avoids the middle. They play the extremes. On one end of the barbell, they are hyper-conservative. They keep 80% or 90% of their wealth in extremely safe assets, cash, government treasury bills, or paid-off real estate. This is your fortress. No matter what happens to the economy, this side of the barbell ensures you will never go broke. You sleep well at night. On the other end of the barbell, they are hyper-aggressive. They take the remaining 10% and put it into high-risk, high-reward bets, angel investing in startups, speculative crypto, or options trading. Here is the magic of the barbell. Your risk is capped. The most you can lose is that 10%. If those risky bets go to zero, you're still rich because of the other 90%. You are safe. But your upside is uncapped. If one of those startups becomes the next Google or that crypto coin goes up 100x, it moves the needle for your entire net worth. You have combined the safety of a grandmother with the aggression of a venture capitalist. You have eliminated the risk of ruin while keeping the possibility of a windfall. That is anti-fragile. To build this kind of system, you have to unlearn something the modern world loves: optimization. We are obsessed with efficiency. We want to maximize every dollar. We think that having cash sitting in a savings account earning 1% is inefficient because it could be earning 8% in the market. But efficiency creates fragility. Think about a race car.
It is perfectly optimized for speed. It is lightweight, aerodynamic, and tuned to the millimeter. But because it's so optimized, it is fragile. If it hits a tiny pebble on the track, it shatters. It only works in perfect conditions. Now, think of a Jeep. It is heavy. It is unaerodynamic. It is inefficient with gas. But it can drive through mud, over rocks, and through water. It is robust. When you optimize your finances, when you invest every single penny, when you leverage your house to the max to buy more rentals, you are building a race car. You're great as long as the track is smooth. But the economy is not a smooth track. It's an off-road trail. You need to be willing to be inefficient. Keeping 20% of your net worth in cash drags down your overall returns during a bull market. It feels like a waste. But when the crash comes, that cash allows you to buy up distressed assets while the optimized investors are being forced to sell. Inefficiency is the price you pay for survival. Do not try to squeeze every drop of juice out of the lemon. Leave some slack in the system. That slack is your shock absorber. And finally, to become antifragile, you must change your relationship with stress. We tend to try to smooth out our lives. We want a steady paycheck, a steady market, a steady path. We try to suppress volatility. But suppressing volatility is dangerous. It's like suppressing a forest fire. If you stop every small fire, dead wood builds up on the forest floor. Eventually, a fire starts that you can't stop, and it burns down the whole forest. In the 2008 financial crisis, we saw what happens when the system tries to eliminate small risks. We created a great moderation where everything looked calm, until the pressure built up and exploded the entire global economy. In your own life, you should welcome small stressors. Don't shy away from small losses in your portfolio. They are information. They teach you what you did wrong without killing you. A small loss today prevents a catastrophic loss tomorrow. If you're an entrepreneur, don't try to get one giant client who pays all your bills. That feels stable, but it is fragile. If they leave, you die. Instead, get 10 small clients who are annoying and fluctuate. It feels chaotic, but it is anti-fragile. If one leaves, you don't care. You want a financial life that gets pushed around a little bit. You want to be exposed to the noise. You want to feel the bumps in the road so you can adjust your steering rather than falling asleep at the wheel and driving off a cliff. The goal is not to find a place where nothing ever goes wrong. The goal is to build a life that can handle things going wrong and maybe even profit from them. When you are anti-fragile, you stop fearing the future. You know that if things stay the same, you win. And if things go crazy, you might win even bigger. You have positioned yourself to benefit from the unknown. You are prepared for chaos. Now, let's zoom out to the longest possible view.
Chapter 15. The Infinite Game. There are two types of games in life. There are finite games. Think of football or chess. These games have known players, fixed rules, and most importantly, an agreed-upon ending. At the end of 90 minutes, the whistle blows, someone wins, someone loses, and everyone goes home. Then there are infinite games. There is no time limit. There is no finish line. The rules change constantly. Players enter and exit. The goal of an infinite game is not to win, because winning is impossible. The goal is simply to keep playing. Business is an infinite game. Life is an infinite game. And building wealth is definitely an infinite game. The problem is that most people play finance like it's a finite game. They say, I want to hit $10 million. They treat it like a finish line. They sprint toward it, taking massive risks, sacrificing their health, and neglecting their families, thinking that once they cross that line, the game is over and they have won. But what happens if you hit the number? The game doesn't stop. You still have to manage the money. You still have to live your life. You still have to find purpose. And if you crash and burn trying to hit the number too fast, you get knocked out of the game entirely. In this chapter, we are going to shift your timeline. We are going to stop trying to win the quarter and start trying to win the century. Sustainable growth versus burnout. In the infinite game, the most important metric is not return on investment. It is return on sleepless nights. You might find a strategy that generates 50% returns in a year. That sounds amazing. But if that strategy requires you to stare at screens 18 hours a day, stress-eat fast food, and ignore your spouse, it is not sustainable. In a finite game, you can sprint until you collapse because you know the finish line is close. In an infinite game, if you sprint, you die. You have to pace yourself. I want you to look at your current financial habits. Are they sustainable for the next 40 years? If you are working 80 hours a week to save money, you will eventually burn out. When you burn out, your income drops to zero. That is a terrible long-term strategy. If you are trading volatile stocks and your cortisol levels are constantly spiked, you will eventually make an emotional mistake that wipes you out. The infinite player accepts lower returns in exchange for higher durability. They would rather make a boring 10% a year for 50 years than make 100% in 1 year and then quit. Why? Because of the math we discussed in Chapter 9. Compounding needs time. Anything that threatens your ability to stay in the game, whether it's a risky bet or a heart attack, is the enemy of wealth. You need to build a financial life that is boring enough to be sustainable, but effective enough to compound. You need to find a pace you can maintain forever. Legacy planning and intergenerational thinking. When you start thinking infinitely, your horizon expands beyond your own life. Most people think, will I have enough money until I die? The infinite thinker asks, how will this capital serve the people who come after me? This isn't just about leaving a big inheritance. In fact, dumping millions of dollars on unprepared heirs is often a curse, not a blessing. We've all seen the shirt sleeves to shirt sleeves phenomenon, where the first generation builds the wealth, the second generation maintains it, and the third generation blows it. That happens because the first generation passed down the money, but they didn't pass down the values. They didn't pass down the critical thinking skills you are learning in this audiobook. To play the infinite game, you have to view yourself not as the owner of your wealth, but as the steward of it. You are the current CEO of the family bank. Your job is to manage the capital well, teach the next generation how to be good stewards, and then hand over the keys. This changes how you invest. You stop chasing quick flips. You start looking for assets that will exist in 50 years. You start buying land. You start building businesses with deep moats. You start thinking about trusts and structures that protect the money from stupidity and bad luck. When you realize you are planting trees under whose shade you do not expect to sit, you stop worrying about the daily fluctuation of the stock market. You are playing a much bigger game. Redefining enough. Finally, the most dangerous trap in the infinite game is the moving goalpost. There is a concept called the hedonic treadmill. It means that as you make more money, your expectations and desires rise in lockstep. You think, if I just make $100,000, I'll be happy. Then you get there, and you buy a nicer car, and you eat at nicer restaurants, and suddenly $100,000 feels like struggle. So you say, okay, $200,000 is the real number. It never ends. If you don't define enough, you are a slave to more. There are billionaires who are miserable because they're comparing themselves to multi-billionaires.
They are playing a game they can never win because the scoreboard has no limit. The only way to win the infinite game is to define your own victory conditions. You have to sit down and calculate your enough. How much money do you actually need to live a life of freedom and purpose? Not a life of infinite luxury, but a life where you own your time. Once you hit that number, you have won the financial part of the game. You can stop taking risks. You don't need to double your money again if it risks losing what you have already secured. Knowing your enough gives you the most powerful ability in the world, the ability to stop moving the goalpost. It allows you to step off the treadmill. While everyone else is frantically running toward a horizon that keeps moving away, you can stop, look around, and actually enjoy the wealth you have built. You can switch your focus from accumulating to contributing. Because ultimately, the infinite game isn't about who has the most toys when they die. It's about who played the game with the most wisdom, the most integrity, and the most joy. We have covered the theory. The final chapter is about executing your personal strategy. Chapter 16: The Critical Thinking Checklist. When an airline pilot walks into the cockpit, they don't just rely on their memory. They don't say, "I've flown 1,000 times, I know what I'm doing." They pull out a checklist. They go through it line by line. Flaps? Check. Fuel? Check. Hydraulics? Check. They do this because they know that the human brain is fallible. They know that fatigue, stress, or simple distraction can cause them to miss something critical. And when you are flying at 30,000 feet, a small oversight can be fatal. Investing is no different. You are the pilot of your financial future. The markets are the weather, and your capital is the plane. We have spent the last 15 chapters loading your mind with concepts: probabilistic thinking, asymmetric risk, antifragility. But concepts alone won't save you when the pressure is on. You need a protocol. You need a flight plan that you run through before you ever touch the buy or sell button. In this chapter, we are going to condense everything we have learned into a practical, actionable system. This is your safety net. The pre-mortem. Before we get to the checklist, there is one specific exercise you must do for any major financial decision. It is called the pre-mortem. You have heard of a post-mortem. That is when doctors look at a patient who has already died to figure out what went wrong. It's useful for learning, but it doesn't help the patient. A pre-mortem happens before the patient dies. Here's how it works. Let's say you're about to invest $50,000 in a real estate deal. You're excited. You're thinking about the profits. Stop. I want you to close your eyes and fast forward 1 year into the future. I want you to imagine that the investment has been a total disaster. You have lost all your money. The deal has collapsed. Now, open your eyes and answer this question. What happened? Force your brain to tell the story of the failure. Did the interest rates go up? Did you underestimate the repair costs? Did the partner steal the money? Did the neighborhood decline? By forcing yourself to visualize the failure as a certainty, you break the spell of optimism. You trick your brain into seeing the risks that it was trying to ignore. If you do a pre-mortem and you realize, "Oh wow, if interest rates go up just 1%, I go bankrupt," then you realize the deal is too fragile. You don't make the investment. You just saved yourself $50,000 by using your imagination. The 5-point decision day checklist. Once you have passed the pre-mortem, you are ready for the decision day checklist. Do not make a significant financial move without physically ticking off these 5 boxes. Write them down. Item number 1, the thesis check. Have I written down exactly why I'm doing this? Not just, "I think it will go up," but the specific hypothesis. I am buying this because revenue is growing at 20% and the stock is undervalued relative to its peers. If you can't write it down clearly, you don't understand it. Item number 2, the ruin check. If I'm wrong, can I survive the loss? Remember Chapter 6. If this investment goes to zero, will it change my standard of living? Will it force me to delay retirement? If the answer is yes, the bet is too big. Size it down until the answer is, it would hurt, but I would be fine. Item number 3, the echo chamber check. Who disagrees with me? Have I actually read the bear case? Can I name one smart person who thinks this is a bad idea, and can I explain their argument better than they can? If you can't find a critic, you're the sucker. Item number 4, the emotion check. Am I in a cold state or a hot state? Am I rushing because of FOMO? Am I selling because of panic? Apply the 24-hour rule. If I wait until tomorrow, will I still want to do this? If the urgency is coming from inside you, it's emotion. If the urgency is coming from the opportunity itself, verify it with logic. Item number 5, the valuation check. Am I paying a fair price? Have I looked at the opportunity cost? Is this the absolute best place for my capital, or is it just the most convenient one? Remember, a great company at a terrible price is a terrible investment. If you can check all 5 boxes, you are cleared for takeoff. You execute the trade, and then you file that checklist away in your decision journal so you can review it later. Scheduling quarterly strategy reviews. Finally, you need a maintenance schedule. You are not going to check your stocks every day. That's noise. But you can't just ignore them for 10 years. That's negligence. I recommend the quarterly CEO meeting. Once every 3 months, schedule a meeting with yourself and your spouse if you have one. Treat it like a board meeting. Put it on the calendar. In this meeting, you open your portfolio. You look at your asset allocation. First, check the balance. If stocks have gone up a lot and bonds have gone down, you might need to rebalance. This forces you to sell high and buy low automatically without using emotion. Second, review your whys. Look at the positions you hold. Is the thesis still true? Has the fundamental business changed? If the reason you bought the stock is gone, the stock should be gone too. Third, check your liquidity. Do you have enough cash for the next 6 months? Is your margin of safety intact? And fourth, look for dead wood. Is there a subscription you're not using? Is there an insurance policy that is overpriced? Clean up the debris. This meeting should take 1 hour. That is 4 hours a year. If you spend just 4 hours a year doing deep, critical, strategic planning, you will outperform the person who spends 4 hours a day frantically reading headlines. You are now operating as a professional. You have a system, you have a checklist, you have a schedule. You have removed the reliance on luck. You have the checklist. Let's head to the conclusion to seal your commitment to this new path. Conclusion: the cognitive achievement of wealth. 2 hours ago, we started this journey with a story about 2 investors, one who got lucky and one who got smart, one who treated the financial markets like a casino and one who treated them like an engineering project. At the beginning, the difference between them might have seemed subtle. On the surface, they both just wanted to make money. But now, having traveled through 16 chapters of critical thinking, you know that the difference is everything. We have covered a lot of ground together. We stripped away the illusion of skill that makes lucky people feel like geniuses. We looked under the hood of your own biology to understand why your amygdala wants you to panic sell and why your dopamine receptors want you to chase the latest fad. We learned that your brain is hardware designed for the savannah, not for Wall Street, and that to win financially, you often have to act against your own human nature. You learned that the most dangerous phrase in investing is, "I know." You learned to replace it with, "I estimate," "I calculate," and "I prepared."
You stopped looking for certainty, which is a myth, and started looking for probability, which is the math of the real world. We discussed how to protect yourself from the downside, understanding that avoiding ruin is more important than chasing the jackpot. We built a margin of safety into your life, creating a gap between what you earn and what you spend, not just to save money, but to buy you the psychological freedom to make better decisions. We explored the counterintuitive power of doing nothing, of letting compounding do the heavy lifting while you sit on your hands. We talked about being a contrarian, about having the courage to stand alone when the herd is running off a cliff. And we moved from vague goals to concrete systems, realizing that we don't rise to the level of our ambitions, we fall to the level of our protocols. But if you take only one thing away from this entire audiobook, let it be this. Financial freedom is not a monetary achievement. It is a cognitive achievement. The money in your bank account is just a lagging indicator of your decision-making process. If you have a chaotic mind, you will eventually have chaotic finances. If you have a disciplined, rational, probabilistic mind, the wealth is almost an inevitable byproduct. The world wants you to be a gambler. The entire financial industry is built to keep you addicted to the noise. The news channels need you to be anxious, so you keep watching. The brokers need you to be active, so you keep paying fees. The advertisers need you to feel inadequate, so you keep spending. They are betting on your biology. They are betting that you will succumb to fear, greed, and instant gratification. But now you have the playbook to bet on yourself. You know that when the headlines scream disaster, that is not a signal to run, it is a signal to look for value. You know that when your neighbor brags about a crypto coin that went up 1,000%, you don't feel envy, you feel pity for the risk they don't understand. You know that true wealth isn't about having the most toys, it's about having the most options. The path we have laid out is not the easy path. It is much easier to just cross your fingers and hope. It is much easier to blame the economy or the government or the rigged system when things go wrong. Taking responsibility for your own critical thinking is hard work. It requires you to be humble enough to admit when you're wrong, disciplined enough to stick to the plan when it's boring, and brave enough to act when it's scary. But the reward is worth it. Imagine a future where money is no longer a source of low-level anxiety humming in the background of your life. Imagine waking up when the market has crashed and instead of feeling a pit in your stomach, you feel a sense of calm curiosity because you know your system was built for this. Imagine looking at your children or your partner or your own reflection and knowing that your security is not based on luck, but on a fortress of logic that you built brick by brick. That is what is waiting for you. But listening to this audiobook is not enough. Passive knowledge is just entertainment. Information only becomes wisdom when it is applied. The concepts we discussed, second-order thinking, Bayesian probability, inversion, antifragility, these are mental muscles. If you don't use them, they will atrophy. You have to practice them. You have to catch yourself in the middle of a bad decision and say, wait, am I resulting right now? Or am I falling for the sunk cost fallacy? You have to be the guardian of your own mind. As you go forward from here, remember that you are playing an infinite game. There is no finish line where you stop thinking. The market will change, the economy will evolve, new risks will appear that we haven't even imagined yet. But the principles of critical thinking are timeless. They worked in ancient Rome, they worked during the Great Depression, and they will work in the age of artificial intelligence. Logic does not expire. So do not go back to sleep. Do not go back to being a leaf blowing in the wind of market sentiment. Plant your feet, engage your mind,
Be the engineer of your own fate. We have given you the tools. We have given you the checklist. We have given you the strategy. The execution is up to you. Stop crossing your fingers and start using your mind. Tonight, take one financial anxiety you have, run it through the pre-mortem checklist from Chapter 16, and take one concrete step to fix it. Do not rely on luck. Rely on yourself. You have just finished what 90% of people will never even start. But remember what we discussed in Chapter 9. The most dangerous trap is thinking that consuming information is the same as acting on it. Right now, the algorithm is preparing to feed you the next video. It might be a cat video, or it might be a guru promising you overnight riches. The noise is waiting to pull you back in. If you are ready to reject the noise and stay focused on the signal, this is your home. This channel is not for gamblers. It is for the architects of their own lives. We explore the mental models, the strategies, and the hard truths about money that the mainstream media ignores. So, make a second-order decision right now. Hit the subscribe button, not to do us a favor, but to build your own high-quality information diet. Ensure that the next time you open this app, you are greeted with wisdom, not distraction. And I have one final request. We talked about the power of the tribe. If you know just one person, a friend, a sibling, a partner who is still stuck in the trap of resulting or panic selling, send this audiobook to them. Don't just send a link, send a lifeline. Help us build a community of critical thinkers. Now head to the comments section. I want you to write down the one specific action you are taking today based on this book. Make a public commitment. The theory is over. The execution begins now. We'll see you in the next video.